So what happens if you don't understand gamma, you end up not really understanding what your position is. And that's why it's really important. If we look at that equation, no matter what happens to the stock, you always make money on gamma. Whether it goes up, whether it goes down, you always make money. The question is just, are you going to make enough money to compensate for the theta of the option?
The theta part of it, I always talk about as like an hourglass. It's like if you were to turn the hourglass over, it is draining all of that premium from the option on the top of the hourglass as time passes is draining to the bottom side.
This is why option traders, this is why we call them volatility traders. They don't care about the direction in which things move. They are simply interested in, is this thing going to move around by more or less than what the cost of the option has baked into it.
That's part of the reason why I hate the term generating income from selling options. Nothing is guaranteed. I don't love that idea. There is a flip side to that coin. Don't ever forget that.
You're watching Excess Returns. I'm Matt Zeigler. I'm your resident 5-year-old looking for an education today. What could be a more noble purpose than that? First off, straight off the moon tower, it must be the work of a master. It can only mean Kris Abdelmessih is with me today and joined. I'm getting tag teamed on this one. I already don't like this. I'm already scared. It's the MATCH man, straight from the OCC. Matt Cashman, welcome back. Guys, are you ready to teach me like I'm 5? I'm ready to learn like I'm 5, I'll tell you that.
We're always ready for that.
All right.
Amen.
We're talking about gamma. There's not some Bruce Banner stuff. I don't know where this is going to go. Matt Cashman, I'm terrified of this word. I hear this word. I see this word. I'm supposed to care about cascades and all sorts of crazy things with scalping. And man, I'm just still reading cowboy novels, you know? So what the hell is this? Well, Cormac McCarthy and me are here to learn.
Oh, I love that. How about you let Kris and I make you not allay some of your fears about the word gamma and explain it to you in a very normal way. How about that?
Okay, deal. What is gamma, Matt Cashman?
I mean, what a great place to start. What is gamma? So gamma is a measure of an option's sensitivity to movement in the underlying. So it's really, and it's usually expressed as a decimal, and it is the anticipated change in the delta of the option for every $1 move in the underlying. So was that not scary enough for you? I hope it was not
terrifying.
Scary enough for you.
I'm going to tell you, the only thing I heard there, sensitivity. I know gamma is a sensitive little thing right now. That's what I'm taking away so far.
I like that. I think that's a good way to kind of characterize it. It's a way that people think about how sensitive that option is to underlying movement. And people think about it as a way that delta gets kind of like moved around by this force that we're measuring by this decimal that we express as part of the option. So that's really how you can think about it most broadly. We can talk obviously a lot more specifically about it, but that's kind of how I would characterize it generally.
Okay, one more sensitivity related question. Why is it important that we think about gamma as its own separate little carve out next to delta, next to the other stuff?
Because I think each option has its own risk profile as it pertains to gamma. It has its own gamma. And so we'll get into this as we talk about like where can you find this? Where does it live? But the reason why anyone should care about this as far as that's concerned is that when you're trading one option and it has a particular gamma profile and you're trading another option, maybe against that option, you're buying one and selling the other, one of those is going to have a more powerful force of gamma, and thus it's going to be a more powerful force in your position, and it's going to kind of drive the bus, as it were, as to like how sensitive your overall position is to underlying movement. And that's something that, like, as positions get more complicated, gets a little bit more complicated, right? You're talking about each option has its own individual gamma profile.
Okay, we're here with gamma, its sensitivities, its sensitive neighbor. It's like 2 different flavors of emo kids hanging out with each other. The back of the show, heads down, hands in pockets. Kris, how are we doing so far? And you're here because there's the practical applications of this stuff. You know how to think about it. You know how to teach it. How did Matt do with the definition? Add some color here on the practicality.
I thought the definition is spot on. I mean, the idea is, the first I just think of it as I think of it as the second sensitivity everybody learns. So like the first sensitivity you learn is how sensitive is this option price going to be if the stock goes up or down $1, and that's delta. But the delta changes, and I think I like to just bring it to things that are just like a real world thing. But if your option is like super deep in the money, it acts just like stock. So it has we say like 100% delta. So if the stock goes up, so if the stock is $50 and you're talking about like the 30 call, right? The 30 call is $20 in the money. If the stock goes up $1, well, that call is going to go up by $1 or $2. It's 100 delta. And if the stock goes to 51, or whether it goes to 51 or even 49, it still has 100 delta. Like that option is still going to move by $1 for every time the stock moves $1. So the delta, the sensitivity of the option to the underlying hasn't changed at all, even though the stock's moved. But if we now imagine that the stock goes all the way down to $30, well, at $30, the stock is, now that option delta is going to be only 50%. Like if the stock goes up $1, the option will go up by only 50 cents. So somewhere in that path, our gamma changed the delta of the option from 100% to 50%. So if you were, let's say you were really bullish on a stock and you wanted to have all this delta, well, if you would care if the stock fell and now your option was no longer 100 delta, now it's only 50 delta. So now your exposure to the stock is less than you desired. So that's why you'll care, because your actual position has actually changed. And it's changed, to be clear, it's changed because the stock has moved around, and it's not just changing by a little bit. Like if I own $50,000 worth of stock and the stock goes up $1, I now own $51,000 worth of stock. But if or sorry, that's actually not right. I own 2% of, I guess $51,000 worth of stock. So but what happens is if you have gamma, that's if you have shares. But if you have gamma, the percentage change in your position value does not move like that. So what happens if you don't understand gamma, you end up not really understanding what your position is. And that's why it's really important.
Anything to add to that, Matt, from what Kris just said? And then I want Kris to walk me through some examples here.
No, I think that hits the nail on the head. And it really drives the point home as to the difference between owning the stock and owning the options gamma is really important in that circumstance, because they seem like they have the same exposure until you actually look at it once it moves. And then you're like, oh, wait, this is not the same thing, right? And so that's important.
I'm really intrigued by this idea of owning a different piece. And that's part of what this explanation from both of you so far is telling me, that this is ways to think about owning a different piece of that exposure. So Kris, you want to take me to school? You got some charts or some graphics for me this time?
I do. This is kind of fun. We're going to go back to, 7th grade, 6th grade, maybe, if you were in advanced math as a 6th grader, I don't know. But
I was not.
We're going to go back to middle school math. So what we're actually going to do is going to go back to, like I said, 6th or 7th grade, a little bit of physics, a little bit of geometry. So we're going to take a really basic example. Just imagine you have two vehicles, they're racing each other, and one of them is already moving at 25 miles an hour. It starts at 20. It's like, a wide receiver in Canadian football. It's already got a head start. So you have a car that's moving at 25 miles an hour at T0 at the start of the race, and it's going to stay at that speed, moving 25 miles an hour. And you have another car, Racer B, that's accelerating. He starts at 0 and accelerates at 50 miles per hour. That's kind of acceleration is meters per second squared, miles per hour. So
the Canadian driver thanks you. We appreciate it.
There you go. The racer, actually kilometers per hour in that case, but Racer B is accelerating. So they start at a dead stop, 0. and they're accelerating at 50 miles per hour, meaning that at the end of the hour, their speed will be 50 miles per hour. Okay, so they're constant acceleration until the end of the hour. They're at 50 miles per hour. And remember, the first one has no acceleration. He's just at a constant velocity of 25 miles an hour. And the question is, well, after an hour, how far does each one of these racers get? And so the one at constant speed, that racer is going to they're going to travel 25 miles because they're driving 25 miles per hour for an hour. So if we kind of remember, that's this blue part right here where to compute, this is called a speed time graph, right? The speed on the y-axis and the time is on the x-axis. And the area under the curve is the distance that you will have covered. So if you've traveled 25 miles per hour for an hour, the base, the area under this curve, under this blue line, is going to be the base of this rectangle is an hour long. And the height is 25 miles per hour. So you will have traveled 25 miles after an hour. Pretty straightforward. For racer B, remember they started at 0 miles per hour and they end at 50 miles per hour. So what you can think here is, well, on average, they were traveling 25 miles per hour for the hour. So they're going to cover the same distance, but their speed was accelerating, right? So that's why it's sloping up like this. And so to compute the area under the curve here, we'll remember that this is a triangle, and the area of a triangle is, well, you have the base of an hour, and you have the height of 50 miles per hour. That would be this entire triangle here, but then we take half of that to compute the area under this triangle. So triangle is half of a rectangle. So you're going to get 50 times 1 divided by 2. And so this racer also travels 25 miles per hour. So far so good. This is we see this one racer is moving at 50 miles per hour, is accelerating at 50 miles per hour. So in the next hour, they're going to continue accelerating. But let's see what happens here.
Okay, I need to check in on this. So it's like we have the two racers, and then we have speed, time, and distance as these like 3 different parts here. Mm-hmm. And we're trying to hold all those in our head at once and go like, as we keep incrementally moving around this thing, especially over time and distance, everything changes. It's a different snapshot each time. Am I getting that?
Yeah, because the acceleration what we're going to see is the racer A, they're just always going to travel at 25 miles per hour. So it's straightforward. Like after 2 hours, they're just going to go 50 miles because they're just going at 25 miles an hour. But racer B has this acceleration. So they're going to cover, as you can imagine, they're going to cover more distance in hour 2 than they did in hour 1. And the question here is like, how much more distance? And we're going to see why we're doing this in a little bit. But I want to just review exactly that, because this goes right back to sort of like that middle school physics where, remember I said that the way we computed this is to recognize that's the average, we took the acceleration from 0 to 50, the average was 25, and for that 1 hour. So if we actually break this down, this was the racer B's distance. The distance was acceleration. How did we do this? We said it's the acceleration, which was 50 miles per hour, times 1/2 the change in time. So that's the average. That's how we got the average speed due to the acceleration. And then we just said, okay, our average speed due to the acceleration times the change in time tells us our distance. So look what happens. We took A times half of delta t, change in time, times change in delta t. This takes us right to this equation that's probably pretty foggy for people, but this was the formula for distance covered due to constant acceleration. It's 1/2 a delta t squared. And what I'm pointing out, the reason I'm showing this is because this squared term is actually pretty intuitive. It just comes right from here. This is the idea that on average we were traveling at 25 miles per hour for an hour. is why we ended up with this squared term right here. And you can see it right here. This is where it came from. So it didn't come from anything fancy. It was just saying, hey, on average, how fast am I traveling? And then times how long am I traveling? That's all it is. That's how we got this equation. So this is very important, this squared term here. We're gonna go to the next slide, because then the question is where are we after 2 hours? How much distance have we covered? So again, the blue is straightforward. Now we change. This is a new chart. This is a distance versus time instead of speed versus time. So after 2 hours, racer A has traveled 50 miles. That's kind of obvious. But racer B, we're just going to use that formula that we built up from that intuition of, on average, how fast are we traveling, and for how long do we travel at that average speed. And here we get 1/2 of 50, again, because that's the acceleration. But we traveled for 2 hours, so it's 2 times 2 squared. So the distance traveled was 100 miles. So now, to be clear, if you recall what happened here, racer B traveled 25 miles in the first hour. Then they must have traveled 75 miles in the second hour, because they've covered a total distance of 100 miles. But the important thing to realize here is two things. One, look at the chart of the racer B with acceleration. It's curved. Sometimes you'll hear this term whenever there's a squared in a function, that there's a curvature. The curvature is saying that, well, if you're traveling at a constant speed, you would predict that like maybe you would end up somewhere over here, but actually the delta between the orange and the blue, that represents curvature, or that's due to the fact that there is a squared number in here. So the distance traveled is actually a function of the change in time, but squared. So if you had been traveling for 3 hours, we would have used 1/2 of 50 times 9. So what happens is, like, this orange line really starts to shoot up, right? It's kind of exponential. So this is very, very important, because what we're about to do is actually see that this is exactly what the concept of gamma is. If we just take all of our terms and remap them, we can take acceleration A, and we say that's gamma, and we're going to change delta T, the change in time, that was like 1 hour or 2 hours, and that's going to be the change in the stock price. And then what happens is the distance traveled becomes your gamma P&L. That's your P&L due to the fact that you have gamma, due to the fact that your velocity or delta has been changing as the stock moves higher. So if we just remap every single one of these, you get the exact formula for gamma P&L. Like this is the formula for gamma P&L. It's 1/2 of your gamma times the change in stock squared, which is exactly the same as the distance equaling the acceleration times 1/2 the square of the change in time. It's exactly the same formula. So just to make this concrete, because like in terms of what people, when people actually trade an option, if you go and you buy an option, let's say you buy 20 options, and each one of those options has 0.05 cents of gamma. Just to be clear, 0.05 cents of gamma, what that means is for every dollar the stock, like if the stock moves up $1, the delta of that option increases by 0.05. So if it was a 50 delta option and the stock went up $1, it is now a 55 delta option, a 0.55 delta option. That's all gamma means. If the option was a 70 delta option and the stock went up $1, the new delta of that option would be 75 instead of 70. That's all 0.05 gamma means. So if we take the 0.05 gamma that the option has, and if we own 20 options, we say that we have 100 gamma. So 20 times 0.05 times the stock multiplier on options, which is 100. So we have 100 gamma. And let's say the stock moves $3. Well, what will happen is we just follow the formula, and we see that if you have an option and the stock moves $3 and it has 0.05 gamma, you're going to make $450 due to gamma P&L. That's due to the fact that as the stock was going up, you actually got longer the stock. Your delta or your equivalent share position was growing as the stock was going up, which is kind of giving you that double whammy, why you're getting that curved P&L chart where you make more than just whatever your delta was. That curved amount, that curvature is $450. So in reality, we would say that you made $450 of gamma P&L, but from that, you would have to subtract your theta P&L because this option does decay. And which really brings me to like probably the most important point about gamma and theta is that they are two sides of the same coin, which is that theta is the cost of gamma, right? Because gamma, no matter what direction, if we look at that equation, no matter what happens to the stock, you always make money on gamma. Whether it goes up, whether it goes down, you always make money. The question is just, are you going to make enough money to compensate for the theta of the option? So, I like to say theta is not an edge; it's just the cost of gamma. So we can stop there for a second.
Stop there so I can look at that remember me and say, I remember the example of the curvature on that chart, but I don't remember anything to do with it. And instead, my brain's like, are we talking about Speed Racer, or is this like Dick Dastardly and Muttley? Is Chim Chim going to show up? Give me some comic.
Yes.
I'm Chim Chim in this equation. I think that's what I'm figuring out. Matt Cashman, question for you on this too. That two sides of the same coin thing that he said at the end.
Yeah.
Do you have any other way of thinking about this? This is like, I feel like something just clicked in my brain where it's going, oh, I get it. You make the money on the gamma, but then theta as your cost. How do you explain that? How do you teach that?
Yeah, the theta and gamma thing I think is is interesting because, as Kris said, it is definitely two sides of the same coin. I oftentimes think about, and sometimes I find that the easiest way to teach those things is through metaphor, right? And I have an entire presentation that I do called The Mathless Greeks, where I talk about all the Greeks, but I don't talk about the math behind them. And the theta part of it, I always talk about as like an hourglass. It's like if you were to turn the hourglass over, it is draining all of that premium from the option on the top of the hourglass as time passes is draining to the bottom side, which is you paying, right? Or the option losing its value over time because options, like we always talk about, have expiration dates. That's the biggest difference between an option. I mean, it's not the biggest difference, but it's one of the biggest differences, right? You could buy a stock and own the stock forever. You can buy an option, and if it only has 30 days to expiration, you're only going to own it for 30 days. And so the fact that it has that expiration date is what actually causes the theta to come out every single day, because you're pulling one day out every day, right? Now it only has 29 days. Now it only has 28 days. Now it only has 26. So that's why. But the gamma of that, the gamma that exists as the other side of that coin, thus is very focused in some very specific places, right? That's why those things exist. And like I said before, each option has its own gamma profile because of where it exists on its duration, like within the duration of its life cycle, et cetera, et cetera, et cetera. So I can talk a little bit about where that really lives as far as people, like where you can find that gamma.
Let's take it there now, because now we're into the part of, is the gamma here in the room with us, Matt? Is it with us right now?
Yeah.
Because I'm feeling its presence. I'm sensitive.
The calls are coming from inside the house, Matt Zeigler. They're coming from
we're
inside
jumping.
the house.
Okay.
Yeah.
I love the media jumping we're doing now.
They're
All right, I'm in the
definitely
horror
coming
movie.
from inside the house,
I'm out of
yes.
Speed Racer. I'm in the horror movie.
Exactly. So
Where is gamma?
I have a couple of slides. The first one is the where does gamma live as far as the strikes are concerned, as far as options. In the example that Kris gave, where you're talking about a 30 strike call with the stock trading 50. So it's like super in the money. That option does not have a lot of gamma. The reason why is because if the stock moves from 50 to 51, as Kris explained, the delta of that option stays 100. It's not changing. And what did we say gamma was? Gamma is a measure of the change of the delta. So if the delta isn't changing, that option has very little gamma. Those are the options that are in the money or way out of the money. The same characteristics exist for options that are way out of the money. If we're talking about that $50 stock, like the 100 calls have the same characteristics where they don't have a lot of gamma in them. The actual slide that I have shows where is all that gamma then? Well, guess what? All that gamma exists in the at the money option at its nadir, right? Like at the top of that, not at its nadir, I guess. At the top of that curve is the at the money option. The reason why is because those options are the most sensitive. Their delta is the most sensitive to change per $1 move, right? Because if you think about it, you're changing the characteristics of that option when the stock moves from 50, where it's exactly at the money, up to like 53. That option's completely different now from a delta perspective than it was. And that 30 call that had 100 delta is not really that different because the delta didn't change. It's still the same kind of option, right? It's still an in the money option. It still has 100 delta. So its delta didn't change. Thus, its gamma is very low. So what you get is this kind of similar curve to a normal distribution curve of prices that if you use all of the strikes across the bottom and you use gamma on the vertical axis, you'll see that it looks like a curve, with the most gamma being at those at the money options. The second thing that you need to remember is that it's not just a function of the strike of the option, it's also a function of how much time that option has left in it. What is its duration? How many days to expiration? We always talk about 0 DTE options. That's what we're talking about with this second slide, which is gamma as a function of time. And what I did here is I basically took the same exact option, and across the top, you'll see 0 DTE, 5 DTE, 10 DTE, 30 DTE, and 90 DTE. It's the same option. It's the gamma of the at the money option with no days left, 5 days left, 10 days left, 30 days left, and 90 days left. And you'll see when you graph it at the bottom, the biggest difference that exists there is in that 0 DTE option. That's where the most gamma is going to be because of the same reason that I just gave as far as the actual movement. That option is going to change its stripes the most when the stock moves around. So what you have here is if you're looking for the option that has the highest gamma on the board, you need to be looking for the option that is at the money and that is closest to its expiration. Generally speaking, that is going to be in the at the money option on the 0-day option, right? That's most broadly where you're going to find that. But the characteristics of gamma are such that it is very concentrated in at the money options, and it's extremely concentrated in options that have very little time left to expiry. So that's where you're going to find that.
I feel like I'm starting to understand this idea of where the most gamma is. And then that, dauntingly, I'm almost scared to say this out loud, Kris. That tells me that as I move away from this, that's where this whole gamma scalping thing comes into play. Like as I start to move off around this curvature. Am I...
Yeah. You know, by the way, the way I think of that when one way I think to remember if you've got the at the money option having the most gamma, it's like when you're at the money, that's when the option has the biggest identity crisis. It's like, am I in the money or am I out of the money? Right? It's like an option that
emo
got like a
option
multiple
sensitivity again.
Right there.
Yeah. It's like, do I really want to get all the way into this shoegaze or I'm back to the cure?
Yeah.
I get it. Okay. That's
very
perfect.
existential. That option is very existential crisis oriented for sure.
It's very teenage emo at that age. At that
very
point.
much so.
Yeah, exactly. Exactly.
So Matt, you mentioned regarding the gamma scalping thing. Yeah. I think this is a topic that probably it sounds really strange and confuses people, but it's actually like incredibly. It's easiest to just show it. I'll show
this
it
tool
really
is amazing.
Here we go.
I love this thing. Kris sent this to me and was like, "You're gonna love this," and I opened it and it was like, "You are correct. I do love this."
Yeah. So I've basically vibe coded this thing on Gemini, and so we're gonna keep it super simple. We're just gonna say, hey, the stock price is $100, the strike price is $100.
Wait, you promised me gamma scalping, and all I see is delta hedging. What's going on?
Watch. Right. Well, actually, great question. That's or observation. That's actually what it's the same. The terms are basically interchangeable. Like delta hedging and gamma scalping are kind of the same thing. I think gamma scalping. The reason we call it gamma scalping is that first of all, the idea of scalping is just, hey, I buy something low and then I immediately sell it a little bit higher, and I do that over and over again. It's like this little just way to describe that trading process. But you can mechanically, what happens is if you own an option, you mechanically do this. This is actually, it's really neat. So if you own an option, you will automatically buy low and sell high when you delta hedge it. And I'm going to show you that right now. So again, stock price is $100, and we're talking about the 100 strike, which is the at the money, which will be where the most gamma is. And I'm just going to say that we'll put the implied volatility at 25. The realized volatility is going to be 25. And we are going to say that we are long this call option. So you can imagine this is an at the money call. So we're going to say, hey, we're long this at the money call option. And we're going to start off, we're going to start off delta hedged. Like we're just going to pretend we're long one option and we're short 50 shares against it. So we have no delta to start. Long 50 delta option, short 50 shares. And what we're going to do is we're just going to say, hey, let's just pretend the stock moves a little bit every day and see what happens. So I say next day, right? And I just increment the day by 1. And what happened is the stock here went from 100 and went down. It looks like it went down 7 cents, right? So the call price, remember, it was an at the money call. So if the stock drops by 7 cents, the call price dropped here by about 4 cents, which makes sense. It's like it went down about 50%. Like if the stock dropped 7 cents, the call we expect to drop by about 3.5 cents. The option delta fell just a hair. And what happens is we made a little bit of money on our short shares, right? Because we were short the stock. So we were short 50 shares and it went down 7 cents. So we make a little bit of money and we lose a little bit of money on our call option, right? So but then what happens is our delta has become a little bit shorter than it was. So we need to buy some stock to rebalance. And that's what this green arrow is here. This will be a little easier to see if I'm just going to add several days in a row really quickly like this. So, oh man, this stock just keeps going down, right? We're like down to $91 here or so.
Clearly, I bought it. That's my fault.
So what's happening is like the stock dropped. So our call option loses delta. As the stock is dropping, you can see what's happening here. Our call option is losing delta. That's due to the gamma. So the delta is falling. But remember, we started being short about 50 shares. But now, like if we think about on day 2, by the time we're at day 2, the stock has now dropped more than $3 from where it started. Okay. So now that 100 call only has about a 37 delta. So I need to be buying shares back from that originally short 50. So I need to be buying some to rebalance. So what happens is every time the stock goes down, I end up buying shares. And every time the stock goes up, I'm going to be selling shares out to rebalance. And this is completely mechanical. So these green arrows says, hey, the stock is dropping, I'm buying shares. Now, I'm just going to keep going forward. This stock just keeps dropping. Ooh. There we go. We get an uptick here, okay? So we can see that from day 10 to day 11, we got a small uptick in the stock. Okay? So what happens is we needed to sell some shares. So we go from being short 6 shares to being short only 2 shares. So we need to buy 4 shares. We need to sell 4 shares there. This is a sell, then this is a buy, and then we keep doing that. There we go. We get uptick, but notice what's happened. This stock has just gotten wrecked. It's now down to 84.94. But look what's happened. The delta of that option is now 0. Like we're no longer buying and selling shares anymore because we are long a worthless option that has zero delta to it. So there's no longer any share position. So we ended up buying and selling these shares through the life of the option. And then this is our running P&L over time. And we can see that we made about 15 cents on this option. This option started off about $3.44. And we ended up making 15 cents by all of these little buys and sells over the life of the option. And so although we're making all this money trading the stock, the option has been decaying the entire time as well. So the net of all of this tug of war between the gamma and the theta is that you ended up making about 15 cents before costs, right? There's no trading costs in this. So that's basically how gamma works. But if I had stuck in a realized volatility, if I said that the volatility was twice as high, like 50 realized vol, and I kept the implied vol the same. If I keep the implied vol the same, the theta of the option is the same. It decays just the same amount. But I would have been capturing larger buys and sell moves every single day if the realized volatility was 50 instead of 25. So I would have been making more money buying and selling the stock and paying the same amount of rent effectively for that right, because the implied volatility was so low compared to the realized volatility. So we basically call it gamma scalping, because what we're saying is, hey, every single day, my gamma changes the delta of the option, which in turn forces me to buy low and sell high in the stock to maintain a delta neutral position.
And you'll notice one quick thing I want to add to this. You'll notice when Kris was showing that, and he showed the actual the stock going down, you probably heard me go like, ooh, ooh. And the reason why is not because the stock was going down, but because from an option trader's perspective, when you look at that and you've traded a position like that before, and you see a stock moving unidirectionally, you realize like this is not good. And the reason why is not because it's going down or because it's going up. The reason why is because gamma, when you're long it, functions best when things do this, right? When they're up and down, not just like unidirectional, one directional move that goes straight down. Because think about it, all you're really doing, you bought the call, you sold 50 shares of stock, and then all you do for the next 30 days is figure out how many shares of stock you're going to buy at a lower and lower and lower and lower price. And it's not, as he showed, that P&L is not horrible, but it doesn't really overcome the amount of theta that you're necessarily paying, or that difference is incremental. It ends up being small and you make like a dime or 15 cents or whatever on it because it just moved one direction. If he showed the exact same thing, but it went like this, you would see at the end of it, you'd make like $4 or something, right? Because you're buying stock down $1, you're selling it up $3, you're buying it down $2, you're selling it up $6. That's when the realized vol, which is the actual movement of the underlying, how much is this thing really moving around, is much higher than the implied vol that you paid for it, right? And so that's, that I think is an important distinction to draw when you're talking about delta hedging in a delta neutral way, is that long gamma particularly works exceptionally well when things move in both directions very quickly.
Yeah, to Matt's point, by the way, if you notice what happened, this is the running P&L chart over time. Remember I said that you made about 15 cents? Notice you made it all between day 1 and day 2.
Yeah.
And then you basically lost a little bit of money and made a little bit back. But basically the entire P&L came, unsurprisingly, from the day that the stock dropped. It was from day 1 to day 2. That was this daily P&L. This big daily P&L here where you made about 17 cents in one day on the trade. Yep. It's all because the stock dropped $3 in one day. So remember like a $3 move on a $100 stock is about a 48 vol move, right? We'd multiply by rule of 16. So it's about a 48 vol move, but we're only paying theta as if the option has a 25 vol.
Yeah.
So all the P&L is being driven by that one day, and you can see like the rest of it is basically a push. So to Matt's point, it's like, by the way, that actually brings up one more point on this I want to say, is that gamma is a really strange concept because if you are long gamma, you want the large moves to happen when you have the long gamma.
Yeah.
Like, for example, had we just drifted down $1 a day and then at the very end dropped $5, it would have made no difference to your P&L because you would not have had any gamma at that time. It was already a zero delta option. So even though you technically own this option and the stock had a gigantic move at the end, you didn't have any gamma. So you didn't get to enjoy the benefit of being able to scalp the gamma because you didn't have any gamma. So this is why you'll sometimes hear people say that options P&L is incredibly it's path dependent. And what they mean is if I'm long gamma, I need the stock moves to happen while I have that long gamma and not when the stock is far away from the strike. And to flip it, this is very relevant today. This also goes for if you're short options, you want the really quiet moves to happen when your gamma is very high, because that's also when you're collecting the most theta. So if the stock makes a really large move in your short options, but the options are really far out of the money, it doesn't really matter. But if they were at the money and the stock makes a large move, you're going to be pretty sad.
Yeah, it makes a huge difference.
All right, Matt Cashman, give me kind of like the personal application, like who as an individual for their own money and whatever they're doing should actually care about this, and then give me the professional application, like who's a professional that needs to know this. I need to put this in the real world.
Yeah, in the real world, I think there's a couple of different ways you can think about this. Number one is you can think about it for your own book, like trading your own money and how do I make money trading options, right? That can be a practical application of looking for a scenario where you're looking for something to happen. You think something might happen that the market is not necessarily priced in perfectly as far as the implied volatility is concerned. You think in the next 30 days, the thing might move more than its implied volatility, and you go and buy those options and then scalp the gamma yourself. Or you just buy it and wait for the giant move and then, hedge the giant move that you were expecting, et cetera. That's one way you can do it. The other way that you can do it, and certainly a way that I'm starting to see a lot more people start to think about this, is this kind of interesting secondary way to look at it, which is I know as a retail investor that there are a bunch of professional investors or professional market makers that are out there that have these positions, have these gamma positions, and are actually forced to hedge their underlying positions. And that in turn creates a market dynamic that either suppresses volatility or creates exceptional amounts of volatility around certain strikes, around expiration, right? You see a lot of people start to talk about option flow relative to strikes in the SPX or something like that. There's a lot of chatter about that on like FinTwit and things of that nature. And people are starting to look at it in a much more democratized way, meaning there's a lot more people looking at things like that than just, 10 years ago. People like Kris and I were the only people that were really talking about like, what is the position? What's the open interest? Where do people own a lot of gamma? Where do people not? How is this going to affect delivered volatility, et cetera? And so that conversation is starting to happen a lot more, which I think is really interesting. And then the professional aspect of this is really just, I think, most commonly shown in the market making community, where someone's making markets in these products, taking on positions, carrying inventory, and then managing the Greeks that come with that inventory position. And so they are, as a natural part of their market making business, hedging back and forth these moves that are happening. And so you see that in a professional way for sure in the market making community. That's kind of like built into the sauce of what the market maker does. And we understand this at a very basic level because it's part of how you're taught as a market maker. If you get, if you have a bunch of options in your book and you're long a bunch of options, you better hope the thing moves around a lot, because the delivered volatility of the underlying is going to be the factor at play in whether or not you're going to make money, because you're paying theta no matter what, right? Like, you better hope the thing moves. And so there's that in the professional community, that's really baked into the way that people just think about the options. But I think it's changing in the retail side of things as people start to learn more about this and why it matters. And that's kind of the reason why we're doing this in the first place.
Kris, same question for you. Just like, who as an individual cares about this? Not just emo kid emotional inventory. Who as an individual cares? Who as a professional cares, and why?
Yeah, I think I just want to drive that point home that long gamma, if we remember what that equation was, which is half of your gamma times the change in stock squared, that number is always positive, right? If you're long gamma. So you always have a positive gamma P&L. If the stock moves at all, that number is going to be larger than zero. And the question is was the rent too damn high? That's really the question. So was that gamma P&L large enough to overcome the cost of the option? And I'll just say that that's probably the biggest aspect of this. This is why option traders, this is why we call them volatility traders, because they're not interested. They don't care about the direction in which things move. They are simply interested in, is this thing going to move around by more or less than what the cost of the option has baked into it? And that's why we call them volatility traders, and why they are indifferent about the actual direction of the market. And it just reinforces the point that theta is the cost of gamma. And just because I see some conversation sometimes about people thinking like theta is an edge, it's like, oh, I should sell the option because the option always decays. And yes, but the other side of the ledger is that there is always a gamma P&L on the other side of that. And what you're trying to do is discern, is the theta P&L going to be greater than the gamma P&L, and vice versa. So you can't just look at one side of the ledger. So that's like looking at your revenue without your costs. It doesn't make any sense.
All right, well,
amen. I could not agree more with that. That's part of the reason why I hate the term generating income from selling options, because I'm like,
we can't. Don't whiz on that electric fence today, my friend.
Well, I just don't love the idea that it gets transmitted as like guaranteed income, right? Nothing is guaranteed. I don't love that idea. And so the point that Kris makes is very prescient as far as that is concerned, right? There is a flip side to that coin. Don't ever forget that.
Matt Cashman, people want to bug you on the internet, find out more about this stuff. Where should they find you these days?
You can find me on LinkedIn and X, and at optionseducation.org, which is where we host all of our educational resources for the company I work for, which is OIC. So check that out. Awesome.
Kris, same question. People want to bug you on the internet. Where are they finding you these days?
I'm on X, and you can just check out moontower.substack, where I write every week about this kind of stuff.
You're watching Excess Returns. The cost to subscribe to this channel is definitely too damn high. Thanks, guys. Talk to you soon.
Thank you.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.